What's up, Craig?
What's up, Brad?
Not much, man. We got to catch up for lost time since we didn't do this last week.
Yeah.
What's going on, everybody? Everyone's watching.
Merry Christmas, Happy New Year, all the good stuff.
Yeah. So last week we took some time off. It was kind of a short week, so we unfortunately were not able to jump on and do a live presentation. So, like I said, we're going to make up for last week's absence. And today we're going to talk about investment properties and the different types of loans available and the different situations that people might be in that we can help with if they're trying to buy an investment property. So, Craig, why don't you want to start with like the different types of loans available first and like down payment differences from one loan to the next?
Yeah. So I feel like I want to concentrate on first what we were talking about yesterday, two types of loans, FHA and VA. And you made a good point yesterday by saying that these loans are really dedicated for primary residence financing. But with using VA and FHA, which are typically primary residence financing, you are able to buy a multifamily home. And what a multifamily home is a home that is more than one unit, right? 2 to 4 unit properties. So meaning you still have to occupy one of those units, but the other 2 or 3 units in that property can be rented out. So I feel like a lot of people don't think that way in terms of viewing those loan types, VA and FHA, as investments, so to speak, because technically you have to live in one of those units. But we'll talk about those two first because those particular loan types allow for the most financing. So, for example, if you're a veteran and you have your certificate of eligibility and you qualify, based on other standards for a VA loan, you can get up to 100% of the purchase price for a 2 to 4 unit property. I mean, that's awesome. An FHA loan allows up to 96.5% financing on a 2 to 4 unit property. And both have really low credit score requirements. So in most cases, and you got to check with your lender, in most cases, in our situation, 620 for a VA, 620 middle credit score is required for a VA, a 600 credit score is required for FHA. But both offer some investment component. And what a better way of, looking at building a portfolio is moving into a property that's a primary residence and also being able to offset some of that mortgage payment, right, with rental income that you're receiving. And it gets you started if that's the goal that you have, is to kind of build a portfolio of rental property.
Yeah, I like to call this house hacking. It's kind of like, for a lot of people, it could be a stepping stone, right? Like they don't own a property. Maybe they're renting or living at home with family rent free, and they want to buy their first house. This is definitely something to consider, because knowing what I know now, like if I would have done this, like I probably prefer to have done this when I bought my house, because it's great. Like you could buy a 2, a 3, or 4 unit property for as little as 3.5% down, or in the event you're a veteran, nothing down. Live in that property, because we'll both agree, right? There's no penalty for moving out of that property in the future. Like these are primary residences that you're using partly for investment purposes, but at the same time, like you don't have to be there forever. So this is a great stepping stone where you buy your first investment property. Like you said, you're going to offset the mortgage payment. So let's just say, for instance, you have a $2,000, let's call it, say, a $2,500 payment on a 2-unit home, and you can rent the 1 unit out for $1,500. Now you're only paying $1,000 a month to live in a house that's yours, right? And now you could do that for a year, 2 years, 3 years, save money, and then essentially move out of that property, buy maybe a primary single family home, a little bigger, white picket fence, all that stuff, but now turn that unit that you're vacating into another rental unit. And now you're covering the entire mortgage payment. So I look at this option. Some people buy the 2-unit, the 3-unit, and live there forever, and they just use it to offset their payments, so it's cheaper to live, which is great. But also, like I said, it's a great stepping stone to get into the investment game.
Yeah, and just to reiterate, so everybody knows, is that there's no avoiding the fact that you have to occupy one of those units. I want to be clear on that, so people understand that it's not intended for the use of a true investment property. You do have to occupy one of the units of a multifamily home in order to get those two types of loans. So getting into the most common type of a true investment loan would be your standard conventional financing offered through Fannie Mae and Freddie Mac. Now, to reiterate or get back to what we were just talking about, primary residences, right? You're able to buy a multifamily home primary residence with a conventional loan. They just require higher down payments, right? So a 2-unit property, you're able to go up to 85% financing for a primary residence. A 3 to 4 unit, you're able to go up to 75% financing. And, you know, typically why you would do a conventional loan versus an FHA loan, right? It might be because at 85% financing for a 2-unit property, the mortgage insurance is going to be a lot cheaper than with an FHA loan on a 2-unit property. And it eventually comes off, right? Unless you're putting 10% down on an FHA purchase transaction. 3 to 4 unit property, you won't need mortgage insurance because the requirement for down payment is 25%. And any conventional loan where you have 20% more down payment, you're not required to have mortgage insurance. These are typically loans that are probably better for the higher credit tier borrowers, right? Because mortgage insurance is more affected by credit and down payment, and interest rates are more affected for conventional financing on these multifamily homes. But it's still available, right? Getting to the point, and I don't know if you have something to add to that before we kind of dig into the real true investment
Yeah, I
property.
mean, just the conventional, like you said, it's typically when you have higher credit scores, you're going to lean that direction. Or if you're doing a true or a conventional, I said, or if you're doing a true investment property, obviously you're leaning towards that, you know, because you can do investment properties without occupying them using a conventional loan. And the third is that obviously there are different down payment requirements, but you can obviously put less on the VA and the FHA. So if you're going to occupy it and then rent out a unit, that those products are going to require less. So the conventional loan is typically going to require a little bit more down, depending on how you're going to occupy the home, obviously.
So kind of concentrating now on true investment property, non-owner occupied. I'm not going to live in the property. I want to use this as a rental property. So conventional loans, single family homes, and that's the category of a townhouse, a condo, and a row home, a rancher, you know, a single family detached property. You're able to go up to 85% and obtain mortgage insurance. So that's pretty good in the investment world, where most people might think that they need, you know, 20, 25% down. You are able to buy a single family investment property with as little as 15% down. Anything that's 2 to 4 units, that's an investment property, you're going to be required to put down 25% for a true investment. Getting to a newer loan, that's, I would say, I don't know how long, Brett, it's been around, maybe for the last couple of years. We've been starting to do a little bit more of this. We actually just closed one yesterday with this type of program. It's called a debt service coverage ratio loan. So this is what we consider a non-qualified mortgage product. It's outside of the traditional mortgage products that are offered via FHA, USDA, and conventional. But this, amongst many other products that are offered by non-qualified mortgage lenders, has a very unique way of qualifying somebody. And the DSCR program stands for debt service coverage ratio, basically only qualifies you as a borrower based on the rental income property that investment property makes. So the subject property income is the only thing that's used, including your credit score, right? I mean, there's no employment required. There's no income from employment required. There are other requirements, but those are the two main factors involved, is just credit score and qualifying income. And I categorized three different things, or three different subproducts under that program that I'm aware of. And the basis of the main way of qualifying is basically a 1-to-1 ratio. So if your mortgage payment is $1,000 and the subject property income, rental income, is $1,000, that's a 1-to-1 ratio. That means that you would qualify based on the down payment requirement at a certain credit score, income-wise, right? So there's no other employment, no other income. It's a really good loan for, let's just say you're a self-employed individual. You want to get started with an investment property. Maybe you've been self-employed for only 1 year. A traditional mortgage might not be what you want to look for, but you still want to invest in this market because interest rates are lower. It's an awesome product if you want to avoid employment and income, or you have problems qualifying for a traditional conventional investment program. I don't know if you want to add to that, Brad, or.
Yeah, I mean, I just think it's great for anybody that's not showing enough to qualify. I mean, the two things that are keeping people from investing is the money required. So you do have to have the down payment, but also the income required to afford that home. You know, because, and correct me if I'm wrong, this program, that it does require that you have a primary residence. So you got to think in terms of that. Like if you are a person where you're making, you know, whatever you're making, you have a payment already, right? You already have a payment that's associated to housing, and then whatever your other debts are, there might not be a lot left over to be able to qualify for an investment property. So this is a great program. And I'll touch on that really quick, why that's required. The reason it's required that you currently own and live in a home is because these investors do not want people using this program to buy a primary residence. They don't want someone coming and saying, hey, I'm going to buy an investment property, underwrite it based on the rents received, and then a month later they're living in the property. Well, guess what? That rent was never being received. It's not going to be received. So now, does that person afford the home? So that's why they require that you own a primary residence, just to pretty much guarantee that this house is going to be used as an investment property. So yeah. I did want to add that in there.
Yeah, and some other sub products under that DSCR program is, let's just say the rental income from the subject property doesn't cover the mortgage payment. These non-qualified mortgage lenders have programs that allow for a lower ratio. It just requires more money down and a higher credit score for higher loan to values. They also have a no ratio rental requirement, which is awesome. It limits what you're able to, to borrow as far as funds are concerned, but you don't even have a rental ratio in that situation. It's as close as you can get to like a no documentation loan when you're just really underwriting off of credit, as long as you have the down payment money. So very good programs. Just really quickly, from what I know, 740 credit score allows you up to 85% financing for that 1-to-1 ratio loan. 660 to 720 credit score allows you to go up to 80% loan to value. The low ratios loans, any rental income where that's less than the subject property mortgage payment. And when I say subject property mortgage payment, I don't just mean principal and interest. That's taxes, homeowners insurance, association fee if there is one. 740 credit score up to an 80 LTV, 700 credit score up to a 75 LTV, 680 credit score up to a 770 LTV. The no ratio loan, which is awesome. If you have a 740 credit score, you can put 30% down and you don't need rental income to qualify. So it's a very good loan. Like I said, for somebody that doesn't want to use traditional methods of underwriting to qualify, and also maybe maybe you don't want to go through the headaches and you're okay with a higher interest rate with this type of program of qualifying on full tax returns. So these are the four main products that that are available as far as investments are concerned. I don't know if you want to touch on anything before we kind of get into our next topic. And
yeah, no, I think it's an amazing program, and we wanted to learn a little bit about them and get some under our belt before offering these. Like you said, they've been around for a while, but it's in the very beginning when we started looking into this, it was almost like fitting a square peg in a round hole, and I feel like a lot of times that's the case when you're not totally familiar with something. But after going through the process, and you could tell me differently if I'm wrong about this, it was pretty simple to underwrite this loan. Like the process of getting that initial approval was pretty quick, because there's a limited amount of documentation and the underwriters act quickly with that.
Yeah,
I think that's another upside to this.
So the main thing that I would think is important here is good credit, right? And appraisal is a main piece of qualifying, and the amount of money you put down. And the next topic I want to talk about is reserve requirements. And if you're not familiar what reserves are, these are typically like emergency funds, right? Funds that are available to a borrower of money after you've spent money on settlement. And they determine these reserves as months of mortgage payments, right? So when we think of what's considered 1 month of reserve, 1 month of reserve is equal to 1 month of the subject property mortgage payment. And every loan type requires reserve programs for the most part when you're talking about having either a traditional investment property or an investment component to that property, right? They all have these requirements, and I just kind of want to touch on these pretty quickly on what's required for FHA, VA, and conventional loans.
So basically, to elaborate too, the reason for the reserve is because you're not going to be occupying the home. So if, God forbid, you get in a financial jam, statistically speaking, you're more likely to walk away from the property because it's not putting a roof over your head. So that's the reason they're requiring the reserve funds, is just to kind of eliminate some of the risks, to say, okay, they have a little bit of money saved. If God forbid something does happen, financially speaking, they do have the money to make a few months mortgage payments. So I just wanted to elaborate on that, Craig.
Perfect. Yeah. So to go through quickly what the reserve requirements are for the main primary the multifamily properties for FHA and VA. For a 2-unit property for FHA, there are no reserve requirements. So if you're buying a 2-unit property, you don't need additional funds in the bank after you pay for down payment and settlement fees. For a 3 to 4 unit property, you need 3 months reserves. So if your mortgage payment is $1,000, right, that's $3,000 of reserve funds. And those funds, let's just say your down payment and closing costs together are $10,000. That means you need a total of $13,000. You're spending $10,000 and have $3,000 in funds left over. Subject property for a VA loan, a 2 to 4 unit property has 6-month reserve requirement. So no matter what, you need 6 months of a mortgage payment in assets left over after down payment and closing costs. Now, regardless of let's just say, for example, regardless of, you may only need $6,000 at settlement for a VA loan. And the good thing is you need 100, you can get 100% financing. So the reserve requirements might be able to be met more easily for a VA loan because you don't need anything but, your closing costs, essentially. If you get those paid for, you might only need, even though the reserve what I'm trying to say is, even though the reserve requirements are higher for VA than FHA for these properties, you might have that available as a veteran because you don't need as much assets as an FHA loan or a conventional loan. For a conventional loan, subject property requires 6 months reserves. That's buying a traditional investment, right? Not owner occupied. But if you own other properties that are not considered your primary residence, right? They determine reserve requirements differently. So you need 6 months of reserves for a conventional loan, but the other mortgages or properties that you have mortgaged, based on the number of properties you have financed, you're going to need a certain percentage of the balances of those loans, right? So, and this is only for investment properties. Like if you own a second home or an investment property, not a primary residence, let's say you own 4 other investment properties, right? We would need 6 months of the subject property in reserves and 2% of the total mortgage balances of those 4 properties that you own, whether they're investment or second home. If it's a primary residence, we don't calculate that. If it's a subject property, we're calculating the months of reserves required for that 6 months reserve requirement. And there's different percentages for more properties you own. 5 to 6 properties financed, you would need 4%. 6% of the mortgage balance, or 6% of mortgage balances for 7 to 10 properties. So a little bit different for conventional as far as reserve requirements are concerned. 6 months for the subject property. If you own additional investments or second homes, it's going to be a percentage of the balance based on how many properties you own.
Did that change? Because I mean, I haven't looked at the guidelines in a while. I feel like it used to be like 2 months reserves for each additional property owned.
Yeah, it changed. I don't know, a few years ago or something.
Yeah. See how long it's been since I've pre-approved somebody. That's why you're on this. That's why you're here, Craig, the guideline guy.
So for the debt service coverage ratio loan, it's 6 months reserves for the subject property, 2 months of 2 additional months of reserves for any other property owned other than the subject property, including primary. So that's a pretty easy calculation. So that kind of sums up reserve requirements, and the basics of this is that if most of these programs, whether you're using FHA or VA for primary residence financing, or you're using, if you're using conventional investment property, traditional investment property financing, or the DSCR program, they're going to have these additional funds that you need on top of what your down payment is. And just to add, it can be money that's sitting in your retirement, right? A lot of people don't understand, okay, I have a 401k, an IRA, a thrift savings plan. We can use 60% of that balance as reserve funds, even though you might not be using that for down payment or closing costs. So that's a good thing to know as well.
Yeah, because this is money. This is only money. To be clear, this is only money that needs to be validated or verified. It's not being used. You're not bringing it to settlement. So, don't get confused by that. So we're just looking to make sure that you have the ability to liquidate accounts, to make payments if, God forbid. And the cool thing, right, Craig, just because I want to mention, guys, if you're watching it, if you're questioning what would be required for your situation, it doesn't take much for us to do a consultation with you. Craig can go over everything with you, determine exactly what's needed, down payment, reserve funds, all of that stuff. So, if buying an investment property in 2022 or anytime for that matter is something that you're thinking about, feel free to reach out because we're here to help to make this even more clear for you.
Yeah, and one other topic I want to go over is just using subject rental income to qualify. I'll kind of try to make this as quick as possible. For FHA and for the subject property, if you have a 2 to 4 unit property, you're able to use up to 75% of whatever the appraisal says that market rent is for a 2 to 4 unit property. A VA loan, similar percentage. But the problem is that if you want to use that rental income to qualify, they require that you've had some landlord experience or you've had experience in property management. So it's a little bit more difficult if you're using the VA to purchase a multifamily property. They require that you have some experience. A conventional loan's a little strange too. It requires whether or not you're able to use subject property income for a 2 to 4 family. For an investment property as well, like a single family as well, but it depends on whether you have history and you have a primary residence, just like we were getting to before, Brad, about, the DSCR program requires you to own a property, right, to make sure you're able to get that program and you're not taking advantage of the system like a loophole to buy it as a primary residence. Conventional financing, they also, if you want to use subject property rental income to qualify, they want to make sure that you have a housing expense. It doesn't necessarily mean you own a property, but they want to document that you have a housing expense to use rental income to qualify. If you have a year worth of experience, or let's just say a less than a year's worth of experience of being a landlord and owning a property, having a housing expense, maybe you're renting out a property, meaning you're paying rent to somewhere to live, and we can document that, then you would be able to only offset the mortgage payment in a sense. You wouldn't be able to get additional income up and above what the mortgage payment is. And if you have more than a year's experience doing a conventional loan for an investment property, then there is no restriction on rental income. So a little bit of caveats to, when you can use it if you have history of receiving rental income or you show no history of receiving rental income in the past. And same percentages apply. 75% of whatever the market rent is able to be used, and that's determined by the appraiser. So that quickly kind of goes over rental income. I don't know if you have something to touch base on that with that, Brad.
Yeah, I do. I think the only thing we didn't touch on is there's a lot of people that own real estate right now, own a primary residence, and maybe they're ready to upsize. This is a great way to start working on your investment portfolio. Is, let's say you live in a 1,500 square foot house, and now you want to upsize because your family grew and you want to move into a 3,000 square foot house. You can actually use 75% of the potential rent for the property you're currently living in, because that's a property you're going to vacate and turn into an investment property and now buy a primary. So you could do it the other way around, opposed to going out and buying an investment property. You can turn your primary residence into an investment property and buy a new primary that's, more suitable for you. The other thing is with VA loans, a lot of people don't realize this, is that you can have 2 outstanding VA loans. So I bring this up because a friend and a client of mine, I don't know, many years ago now, first person I helped do this, is that he basically was living in a condo that was financed using the VA loan. And what he did was he bought the same thing, bought a bigger house, now a single family home, turned the condo into a rental property, and then, bought the primary to live in. And he wasn't using like the proposed rent because he was vacating that property. He had enough to afford both properties, but the VA will actually allow you to get 100% financing as long as the combination of your existing loan and the new loan doesn't exceed the county loan limits, which we all know the county loan limits increased recently going into next year. So you have a lot more wiggle room. So if you have a VA loan and maybe it's on a condo or something and you're looking to upsize, you might be able to turn that into a rental property and buy another home still using the VA with 100% down. So just some couple little fun facts there. If you're
Good point.
You know, and now you don't, and that now you kind of skip that whole reserve requirement, right? Because you're buying a primary, you're not buying an investment property.
So, all right, I feel like we got a lot of information today. I don't know if you have anything else to add, but I would like to say it's been a long year for everybody, and I wish a happy and prosperous 2022 for everybody. And hopefully it's a little bit easier for people.
Yeah, we appreciate you guys. We had a killer 21 and we're expecting to do the same next year. And, you know, we contribute all of that to our referral partners, our clients, our friends, family, everybody that's helped us and supported us over the last 12 months. And we appreciate that and respect all you guys for that. And, you know, like Craig said, we wish everybody that's watching this or that even that's not watching this a happy new year. So hopefully this helped you guys out today. If you have any questions about buying your first investment property or any investment property for that matter, you know what to do. Just feel free to reach out to us.
Awesome, guys. Take care.
Have a great day.